And good morning once again, options traders. Well, a common question that I get from traders who use vertical spreads, they'll say, why is my vertical spread not at the maximum gain? And the risk graph shows that it should be. I don't understand why. Well, again, it's a common question. It's a good question. And like a lot of questions with options, there is an easy answer. So let's go find out what it is. And before we do, as always, please be sure to click like and subscribe. It's greatly appreciated and helps so much to promote the channel. So let's start off with vertical spreads. Let's say that the stock is 102.50. We'll put it right between the strikes. We're going to buy the $100 call, let's say is trading for 8, and we will sell the 105 call, let's say that's trading for 550. And that's going to give us a net debit of 250. That's just the difference between paying 8 and receiving 550. So the net cost to us is 250. And that means that the maximum gain is 250 because we have the right to buy at 100, the obligation to sell for 105. So the most the spread could ever be worth is 5 points. We paid 250, so therefore we can make the balance or 250. So this risk graph, buying the 100 call and selling the 105, looks like this. So here is the risk graph for that vertical spread. I always point out that we get bends at the strikes. There's the bend at 100, that's our long strike, and here is the short strike of 105, and right there is a bend. So traders might put this vertical spread on when the stock is down here. They'll watch it trade up and up and up, and then it hits 105, and they say, oh, look at that. I should be able to close the spread for the full $5 value, and therefore put 250 in my pocket because the risk graph shows that it's at maximum gain. And yet they go to close the spread and they find out it's not anywhere near close to $5. So why is that? Why are we not at maximum value? Well, again, it's a good question. And the answer is that the risk graph is giving you the right information. You're just looking at it at the wrong time. You have to remember that there are always two risk graphs. There's an expiration curve, which is the one that we just saw, and it only applies at expiration. So let's call that the final 10 seconds going into expiration day, right before the closing bell. That's the only time that that risk curve is accurate. At any other time, we have to look at the second curve that is called the current curve or today's curve, and that applies right now. So if we go back to our vertical spread, and if we overlay the current curve here in blue, now we get a different picture. See, this blue curve applies right now, and over time it's going to change. The blue curve will slowly march towards the black line, so the right side of the graph over here will start moving up, and the left side over here will start moving down. And you can see that now that we look at the current curve, we get a very different picture. So we trace a line up here, we look to the left, we say, oh, it looks like it's only worth about 50 or 60 cents, not the 250 profit that we thought we were going to get. So remember, the risk graphs are always showing your profit or losses, what's occurring to you. And so it's accounting for that 250 cost. So it's showing that, yes, we could put a 60-cent profit in our pocket right now, but if we want the full 250, we have to wait until expiration. Now again, this whole concept still seems to throw new traders, and they say, but I don't understand. The stock is at 105, why is it not worth $5? Well, there's a very good analogy. Let's think of a bet, maybe a football bet. And let's say that we have Kansas City and Tampa Bay playing, and we're going to bet $250. That was the value of the spread at maximum gain. So let's say that you take Kansas City, I take Tampa Bay, and at the end of the first quarter, the score is 0-7 in favor of Tampa Bay. So I turn to you and say, hey, you owe me $250 because my team is in the lead. What would you say? You would say, well, that wasn't the bet. The bet was for the final score, for expiration, and we're not there yet. Just because my team is leading after the first quarter doesn't mean that your team can't win. And that's exactly what's happening with the vertical spreads. Now, of course, that's going to change. That perception will. Let's say that we're at the second quarter and it's now flipped to 21-7. I might look at this and say, it's a pretty good turnaround right there for you guys. I'm not so confident in my team right now. Would you let me out of the bet? How about if I give you $100 to call it even right now? And you might say, well, give me 110 or 120, and then I come back with another counteroffer. And this is exactly what happens in the markets. In that example, we are submitting bids and offers to find out what the value of the bet is right now. Let's say we're in the fourth quarter, same score, but now I'm going to have an even bigger urgency to want to close it because I'm saying, well, there's not a lot of time left and there's a pretty good lead over here, so let me go ahead and close it now. And once again, we could go through the same back and forth. I'll give you $200 to settle it now. You say, no, give me 210. How about 205? Again, this is what the markets are doing in the options arena every single day. But now that brings up another good question. Why would we even entertain the idea of settling early? Well, from my perspective, losing $100 is better than losing $250 or whatever number we decide on. And from your perspective, gaining the $100 for sure is better than losing $250, which remember, the game's not over and you still could lose. And so here's a chance to end the clock right now for a sure $100. And again, this is what traders are looking at. How much is it worth to settle the bet now? And so if you keep that perspective, it'll make a lot more sense. So let's go back to our risk graph. So this was the current curve in blue, let's say with 30 days until expiration. Well, maybe 5 days goes by and that curve is going to shift. And let's say it moves from the blue to the red. And then another 5 days, it's going to shift some more. Notice that the right side is moving higher that we talked about earlier, because if the stock is 105 or higher, we are becoming more likely to expire up here at the maximum. Over on the left, there's less time for the spread to move in the money, so the bet is becoming less valuable. So let's say another 5 days goes by, we move to this curve, we move to this one. And then let's say with 5 days, 4, 3, 2, 1, we're right here into expiration. And then in that final day, we finally move to the black curve. Now you should have a better understanding why this curve only applies in the final seconds of that option's life. Because going back to the football analogy, we have maybe 10 seconds on the clock. You might not even have that big of a lead. It might only be 14-7. But with only 10 seconds on the clock, it's relatively speaking a huge lead. And now I might be willing to settle for $2.40 or $2.45. And it's only right at expiration does the bet finally come up to this black curve. So the thing to understand about the max gain with the vertical spreads reach their max gain when the probability of a full payoff is near 100%. And of course, that's a perception of the market, just like it is with a football bet. You might be ahead 14-7 with 2 minutes to go and still lose, but who would have guessed? So in the eyes of the market, they're saying, you know what, this game is pretty much done. Now you have to remember that if a lot of time remains or volatility is high, that spread is not going to reach maximum gain unless the spread is deep in the money. So go back to the football bet. Let's say it's the end of the first quarter and your team is ahead 45-7. Well, yeah, now I might be willing to settle for $240, $245, because you're going, yeah, there's still a lot of time on the clock, but statistically speaking, there's virtually no chance of coming back from this. And if you look at the risk graph, that's exactly what it's showing you. So for example, this blue curve has 30 days until expiration, but you can see that if the stock is way up here at 120, it's worth almost the full value. That's again sort of like your team being ahead 45-7 in the first quarter. But if we extended this graph way out here, eventually that blue and black line would meet probably around 125 or 130. But again, that's like saying if there's 30 days on the clock, traders need to see it super deep in the money before they're willing to push that spread to full value. Now again, very deep in the money is relative to the time on the clock and volatility. If I had shot these curves at a higher volatility, these curves might not meet. This blue and black might not meet until 150 or 160. If I made the volatility a lot less, then they might meet down here at 110. So if you always go back to this idea of a football bet and just realize at what point would you be willing to pay off the full value of the bet if you were the loser, that will help you to understand why traders are not paying off at full value for your vertical spreads before expiration. And so for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a brand new candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.